So it's incredibly important to have a partnership approach to these advanced planning opportunities for high net worth clients. Oftentimes the planning opportunities can get pretty specific into, various types of income or estate tax planning. So it's nice to be able to lean on resources, whether it's the DPL team, PH Rob, or any of the attorneys or accountants that, we all partner with on these transactions to be able to really lean on the collective experience of the group to drive the most value to the client.
Hear how this breakaway firm used DPL's tools and technology to make the transition to independence. You're listening to Advisor Revelations.
Hello, everybody. We would like to welcome you to the DPL Advisor Revelation podcast. I am Amy Arnett. I am Director of Insurance at DPL, and joining me today is Nick Robb with PH Robb. Hi, Nick. Today, we are going to talk about advanced planning strategies and how insurance can be used within those advanced planning strategies. But before we get started, I do want to remind everyone to subscribe to our podcast on your favorite streaming app and to connect with our team at dplfp.com. And there you can find more resources as well. Thanks again, Nick, for joining the discussion today.
Thanks for having me, Amy.
Just a little bit of background on Nick and our partnership with PH Robb. PH Robb works completely in the area of advanced planning strategies. And there are a lot of ins and outs and things that need to be taken care of with advanced planning. And PH Robb does this day in and day out. So they have the system down and can provide the support that we need for your clients when we uncover an advanced planning need. Nick has been with PH Robb for 10 years, and he specializes in designing, building, and managing the insurance transactions that accomplish our advanced planning techniques. He has a very deep understanding of insurance products. We've worked with him now probably for the last 6 to 9 months, and it's been a great resource for us. So I'm happy to have him on our discussion today. Nick, why don't you tell us a little bit more about what you do at PH Robb?
Absolutely. Thanks, Amy. Thank you for the introduction and the kind words. Yeah, so as you mentioned, PH Robb is really a resource, for advanced planning to, advisors across the country. So we work with insurance advisors, insurance BGAs. We work with attorneys, accountants, investment professionals, you name it. Any advisor that has, higher net worth clients that need, advanced planning techniques, either on the income or state tax planning side. That's really where our firm, specializes.
Okay, that's great. That's great. Well, I'm excited for our partnership.
Likewise.
That's for certain. So what would you say would be the ideal client for an advanced planning review?
It's a good question. I think the ideal client for an advanced planning review would be, of course, any high net worth individual. So, clients who have 10, 15, $20 million or more of net worth. Typically, there's planning opportunities there, whether it's on the income tax planning side, estate tax planning. There starts to be opportunities to add value from an advisor standpoint. Oftentimes those clients are business owners. So sometimes there's, business planning opportunities, buy, sell, business succession, things like that. So yeah, high net worth clients are definitely going to have opportunities for additional planning.
And what would you define a high net worth client's net worth to be, a starting point?
Right. Yeah, there's a lot of different definitions that float around in the market for this. I think certainly clients that have $10 million or more of net worth qualify for that high net worth definition. Once you start getting to 30, 40, $50 million net worth and above, that's what we would refer to as an ultra high net worth client, which of course, even more planning opportunities there. But yeah, I'd say 10 million or above.
Okay. All right. Good. So one question that I've heard asked a few different times is, how does insurance reduce someone's taxes?
Right. Well, insurance can reduce taxes a couple of different ways. There's, of course, all the income tax benefits that life insurance policies have, where, all of the growth within the policy is going to be income tax free. So that's one great way that clients can use life insurance to reduce income taxes. More often when we're partnering with advisors, we're focusing on the estate tax. And, typically the way that insurance is used for estate taxes is clients are going to fund a large life insurance policy in a trust outside of their estate, an irrevocable life insurance trust or an ILIT. And, when eventually those clients pass away in the future and there's an estate tax due, you have all of that tax-free liquidity paid immediately into that life insurance trust, which then is available to pay estate taxes. And that's really important for clients who maybe are illiquid or have assets that aren't, can't be readily turned into cash. So, having that source of liquidity in the trust to pay estate taxes can be really helpful.
I suppose then when the insurance is held within the trust, that keeps that insurance out of their estate as well.
It does. And that's a really important point. We see this from time to time where high net worth clients who have taxable estates have life insurance policies that are still in their estate. And sometimes that's from when they were much younger, before the estate planning was really a point of consideration for them. But definitely, it's a great thing to mention that the benefit of that irrevocable life insurance trust is that all of the proceeds are now not subject to the estate taxes because it's outside of the client's taxable estate.
Is there a look back, like if somebody had an insurance policy that was inside the estate, and then they set up their irrevocable trust and transfer that insurance into that trust? Is there a look back period that we have to be concerned about?
So I'm not aware of a look back period, but what would be triggered in that case is, potentially gift taxes.
Oh, that's
so, when we're transferring the life insurance policy from a client's taxable estate into trust, we have to get a valuation done on that policy. This is where the insurance companies themselves can actually be really helpful. They do calculations to tell you what that policy is worth. And then we would work with the client's attorney to actually usually gift that policy to trust at whatever that valuation is. So it does end up using some of their lifetime exemption, or if they've used all of that already, it could be subject to gift taxes.
So when do you feel like estate planning becomes a need? At what level?
That's a great question. I think that estate planning is something that really everybody should have considered. Anytime you've got a client with assets that would like to pass those assets on to some beneficiary in the future at their passing, that's estate planning. So even if it is as simple as working with an attorney to have a properly drafted will that dictates how they want those assets to move, I think that that's important really for anybody. A lot of the estate planning that our firm, works on with other advisors, it tends to be, those higher net worth clients, ultra high net worth clients. And that's where, to your question, when does it become a need? Once clients have tens of millions of dollars of assets, they're really attuned to the risks involved in what that estate planning would look like if they don't, chart it out really explicitly. So, making sure that assets are going to the beneficiaries that they want, having provisions in the trust that protect the family long term, right? To encourage things like family unity, making sure that there's, not any spendthrift, happening at lower generational levels. The just practical considerations that clients have when thinking about passing on large amounts of wealth to their family. And I think that the example that we discussed during our webinar a couple of weeks ago, the DPL webinar that we put on, I think speaks to this perfectly. It's a $30 million family. They've done some estate planning. They're looking at, gifting $10 million of assets to trust. So, wonderful use of that lifetime exemption, but still have a taxable estate remaining. And most of their assets are illiquid, private business interests, real estate. Now, thankfully, the clients are young, so the likelihood that they would both pass away, in the near term is low. But if that were to happen, family would be in, a really difficult position, having to potentially go and sell, pieces of real estate that they've held for a long time, maybe have emotional attachments to these properties. And who knows what the market looks like when they're having to sell those assets to pay estate taxes. So that's a great case study for, where there really is truly a need for that estate planning conversation. And then figuring out how life insurance and whether life insurance can fit into that solution for the family.
Do you ever run much into special needs trust, in that arena where you've got a husband and wife that are supporting a special needs child and may have a significant estate? Would you set up, I guess, two separate trusts, one specific for that special needs child, and then maybe a second as an irrevocable trust for the estate situation?
I think you would. And it's a really good question. Our firm has not had that many opportunities to work on planning for families that involve those special needs trusts, but I'm aware that they're commonly used. And I think it's a great example, again, of why those estate planning conversations are so important. And also working with advisors, whether it's the attorneys or the financial professionals around you that have experience with those types of circumstances.
One other question. How do you feel that insurance plays a part in business planning?
Insurance can play a really important part in business planning. I think the most common use of life insurance in business planning is usually buy-sell. So, of course, the concern or the problem in that case is, you have partners, business owners, and if one of them were to pass, how do the remaining partners or the surviving partners purchase those interests from the partner who passed away? And that can be a really tricky problem to solve, not only from the financial implications of that, coming up with the cash to buy that partner out, but then also the practical or operational day-to-day considerations of what it looks like if you don't buy that partner out. Because usually, now you're going to be dealing with that deceased partner's remaining family members, spouse, kids. And those individuals probably are not going to be well versed in the business. So the surviving partners are going to bear additional duties. They're going to have to do more work essentially to make up for what was lost in that deceased when that partner passed. So buy-sell is a really important consideration for business owners, and that's something that we see oftentimes not exist at all, or the buy-sell plan is really not what it should be. Either, they haven't adequately funded the buy-sell insurance, or they're not reviewing it frequently enough. Typically, that's something that should be reviewed by the business owners every year.
Right. I think that, I've probably run into, in my years of being in the insurance world, quite a few instances where there's not even a buy-sell agreement established, which is scary if you think about it.
Absolutely.
So I guess it's really important that any of the business clients that we work with, that subject is broached to make sure that, hey, this is an important part of your planning, because it could crumble any financial plan that an advisor might put together in that specific situation with nothing being established.
That's absolutely right. I'll give you an example of a situation that we saw very similar to that. It's a current client of ours, large engineering firm. It's privately held. There's probably 70 to 100 shareholders, and they do over $100 million in revenue. So this is a large company. This isn't, 2 or 3, business partners. This is a legitimate organization, and they had a buy-sell, and they had a buy-sell formula and all of that, which is great, but it wasn't properly funded. And the buy-sell required that the, deceased shareholder get repaid over a 5 to 10 year period based on, certain metrics of the company to determine their shareholder value. And unfortunately, the largest shareholder in this engineering company passed away.
Oh, no.
And if I remember correctly, he owned something like 30 or 40% of the shares.
Oh, wow.
So 30 to 40% of the value of that company had to be paid out over a 5 to 10 year period. And, thankfully, the engineering company was generating enough cash flow during that time to be able to make those payments and also cover their ongoing operating expenses. But if you hit a bad business cycle and you have that liability on top of that, this is how businesses unfortunately go under.
Yeah, I guess if you have to go to the bank and borrow the money, that's
costly.
Doesn't look good on your balance sheet.
Right. Exactly.
And when that kind of situation, I guess it depends upon the buy-sell agreement itself, but as they're buying out those shares, is there interest over and above that's paid in addition?
There is, yeah. So ultimately, that's going to be drafted in that formula that they use for buy-sell purposes. In this particular case, I do think there was some interest rate that was applied. So to your point, if the company were in a position where they had to borrow money, not only are you paying interest on the bank loan, but you're also, potentially paying interest to see shareholder if you're paying that out over time. So it starts to become a very costly proposition. which again, when we think about why do companies not do the buy-sell planning up front, or why do they not buy insurance to protect themselves or to fund that buy-sell? Usually, if they've looked at it, it just comes down to cost. They might think that it costs too much. So it's really important to just have the conversation and look at, this is what the insurance costs, but what would it cost if you have a shareholder die and now, you're having to borrow money or you're having to pay it from operating cash flow? What is the alternative and what does that cost the company? So it's important to have those conversations.
Yeah, we need to educate at least so that they are aware and know going in what could or could not happen and how insurance can definitely help support that and keep them solid as a company and not disrupt the whole business plan. So it's definitely very important to be talked about. I agree.
Exactly. And for companies that have cyclical earnings like this engineering and mining company, it just becomes even more important because there's so much uncertainty about what their operating cash flow is going to be year to year. So,
have you ever, in business planning and buy-sell, or maybe even deferred comp situations, have you ever used the premium finance concept in those scenarios?
Our firm has not, but it is used often for buy-sell planning. Actually, this engineering company we've been talking about, they looked at, whether it made sense to finance the life insurance policies that they ended up buying to protect all of the remaining shareholders. But it's often used by businesses. There are some special products out on the market that were really created specifically for this purpose of companies holding the life insurance policies on their balance sheet. One example is a MassMutual policy, which has something called a honeymoon rider or early cash surrender value enhancement rider. The original purpose for those riders really was for the corporate market in buying these policies for buy-sell or business succession planning purposes. And, they wanted the cash value of those policies to basically equal premiums paid early on so that they didn't have, a negative effect on their balance sheet. So there are specific products in the market that are great for this type of planning. And absolutely, you can look at borrowing money from a bank and using assets that the company has as collateral as a more efficient funding mechanism.
Well, just based upon our conversation today, for those of you that are listening, I hope that you are inquiring with your clients about these advanced planning strategies. It is a very important part of that planning package. DPL and PH-ROB are a resource for you to use in those situations. So don't hesitate at all ever to reach out to us. What we've talked about today just barely scratches the surface. And you can find our full on-demand webinar that goes deeper into the topics that we spoke about today in a link with these show notes. And if you want to dive deeper on one-on-one, then get in touch with myself and we'll get a call scheduled with Nick and me and yourselves to dive deeper in with a specific client or a more specific topic. That's what we're here for, to help you. I want to thank everybody for listening, and don't forget to subscribe to the Advisor Revelations podcast and visit the website for more information. Nick, we really appreciate your time today.
Appreciate your time as well. Thank you for having me, Amy.
All right. Everybody have a great afternoon.
Thanks for listening. To hear more Advisor Revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.